What's up everybody and welcome back to the channel. Today we're diving deep into the world of stock analysis, and no, we're not talking about just tracking stock prices, that's the easy part. We're going to unlock the secrets behind those numbers. Financial ratios. These are the tools that can help you understand a company's financial health, its growth potential, and whether its stock is actually a good deal or not. We're going to break down everything step by step in plain English, so you can start using these ratios to make smarter investment decisions right away. So grab your notebooks, your calculators, and let's unlock the power of ratios together. Let's kick things off with valuation ratios, which are essential tools for any investor. The most popular one is the price-to-earnings ratio, or PE ratio. This ratio is widely used because it provides a quick snapshot of a company's valuation. The PE ratio tells you how much you're paying for every dollar of a company's earnings. It's a straightforward way to gauge if a stock is over or underpriced. A high PE ratio could mean investors are expecting serious growth, or it could mean the stock is overvalued. It's all about context. Always consider the industry and market conditions. Then there's the price-to-book ratio, or PB ratio, comparing a company's market value to its book value. This ratio is particularly useful for evaluating companies with significant assets. A low PB ratio could indicate an undervalued stock, but consider the company's industry and overall financial health. It's a good indicator but not the only one you should rely on. The price-to-sales ratio, or PS ratio, compares a company's market cap to its revenue. This is particularly useful for valuing companies that might not be profitable yet, but have strong sales. Finally, the EV/EBITDA ratio gives a more comprehensive picture of a company's value by considering its debt and cash flow. This ratio is often used for companies with significant debt. Compare these ratios within the same industry for meaningful insights. Different industries have different benchmarks, so context is key. Valuation ratios are crucial for finding undervalued gems in the stock market. They help you make informed decisions and avoid overpaying for stocks. We've talked about a company's worth, but what about how much money they're making? This is a crucial aspect that investors and stakeholders are always keen to understand. That's where profitability ratios come in. These ratios provide a clear picture of a company's financial performance. These ratios are all about efficiency. How good is a company at turning revenue into profit? It's a measure of their operational effectiveness. First up, the gross profit margin. This is a fundamental metric for assessing a company's core profitability. This tells you how much profit a company makes for every dollar of revenue after accounting for the cost of goods sold. It's a direct indicator of production efficiency. Then we have the operating profit margin, which factors in operating expenses like salaries and rent. This ratio gives insight into the company's operational efficiency. And of course, the net profit margin, the bottom line, showing how much profit a company keeps after all expenses. This is the ultimate measure of profitability. Return on equity, or ROE, measures how efficiently a company uses shareholders' money to generate profits. It's a key indicator for investors. Return on assets, or ROA, focuses on how efficiently a company uses its assets to generate profits. This ratio is crucial for understanding asset utilization. This one's especially important for asset-heavy industries like manufacturing or utilities. These sectors rely heavily on their assets to generate revenue. By analyzing these profitability ratios, you can get a good sense of a company's overall financial health and efficiency. They provide a comprehensive view of how well a company is performing. Remember, a company can have a great product, but if they can't turn a profit, it's not going to be a good investment. Profitability is the ultimate measure of a company's success. Liquidity ratios. Can this company pay its bills? These ratios tell you how easily a company can meet its short-term financial obligations. The most common liquidity ratio is the current ratio, comparing a company's current assets to its current liabilities. A current ratio of 2 or more is generally considered healthy. The quick ratio is similar but excludes inventory from current assets, giving a more conservative view of liquidity. The cash ratio only considers a company's most liquid assets in relation to its current liabilities. Even if a company has a great long-term outlook, if they can't manage their short-term cash flow, they might not be around in the long run. Check those liquidity ratios before you invest. Leverage ratios. Don't get crushed by debt. Debt can be a powerful tool for growth, but too much debt can be risky. Leverage ratios help us assess that risk by measuring how much debt a company is using relative to its equity. The most common leverage ratio is the debt-to-equity ratio, comparing a company's total debt to its shareholder equity. A high debt-to-equity ratio means the company is relying heavily on debt, which can be risky. The interest coverage ratio measures a company's ability to meet its interest payments. A higher interest coverage ratio indicates a greater margin of safety. Ideal leverage ratios can vary widely depending on the industry. Debt can fuel growth and enhance returns, but too much debt can put a company in a precarious financial position. By analyzing leverage ratios, you can understand a company's financial risk. Ensure the company's debt levels are sustainable. Market sentiment and stock volatility. Reading between the lines. Market sentiment and stock volatility can significantly impact a stock's price. Understanding these elements can help investors navigate the complexities of the stock market. The dividend yield tells you how much dividend income you can expect for every dollar invested in a stock. It's a crucial metric for income-focused investors. A high dividend yield can be attractive, but consider the company's payout ratio and overall financial health. A sustainable dividend is often more important than a high yield. Beta measures a stock's volatility relative to the overall market. It helps investors understand the risk associated with a particular stock. A beta of 1 means the stock moves in line with the market, while a beta greater than 1 indicates higher volatility. Conversely, a beta less than 1 suggests lower volatility. The PEG ratio, or price earnings to growth, factors in a company's expected earnings growth rate. This ratio provides a more complete picture than the PE ratio alone. A PEG ratio of 1 is generally considered fairly valued. However, it's important to compare PEG ratios within the same industry for a more accurate assessment. Understanding market sentiment and stock volatility is crucial for making informed investment decisions. These factors can influence stock prices beyond fundamental analysis. These factors can cause a stock's price to fluctuate significantly, even if the company's fundamentals are sound. Staying informed and adaptable is key. Combine your knowledge of financial ratios with your own research for better investment decisions. This holistic approach can help you navigate the market more effectively. That's it for today's deep dive into financial ratios. We covered a lot of ground. I hope you found this video helpful and learned some valuable tools to add to your investing arsenal. Keep practicing. Understanding these ratios is like having X-ray vision into a company's financial health and performance. It's truly empowering. Don't forget to like this video if you enjoyed it, subscribe to the channel for more investing insights, and hit that notification bell so you don't miss out on future videos. I want to hear from you. Your feedback is important. What other financial ratios do you use in your analysis? Share your thoughts. Let me know in the comments below. I read every single one. Until next time, happy investing, stay informed and stay ahead.